Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First off, we'll have more on the market volatility as stocks waver while crypto plunges. Plus, we'll speak to the CEO of Gap after a strong quarter for the retailer. And OpenAI and Intuit are partnering up. We'll break down the latest deal with the CFO of Intuit. And let's take a look at the major averages here because we do have this bounce back that is going on today, up about 0.5% for the Dow, the S&P 500 bouncing by about 0.4%, the Nasdaq of about 1/3%. So not a huge comeback here, but it seems to have been catalyzed by some comments from the governor of the Federal Reserve Bank of New York, that is John Williams, who indicated he was open to a rate cut in December. Also, if you take a look at the context here for the move that we're seeing today, of course, it comes on the back of a volatile week. The Nasdaq Composite is still down by more than 3% on the full week. So that's something to consider. As we talk about that rate outlook, it's also worth looking at the 10-year yield, which is down, as you can see, over the past few days. This perception rising. Well, there's a divide in the Fed and a lot of debate about whether the Fed's going to cut rates or not. But it seems as though that perception of a rate cut is increasing as the week has progressed, even though stocks have been going down. Here's the Nasdaq on the intraday basis here. So still a decent amount of red on the screen, including NVIDIA, which is still down by 1.4%. I do want to take a quick look at the year-to-date movement here because there's something that stands out in particular from the Mag 7 or the largest cap tech stocks, and that's Alphabet, which is now up 57% on the year, trading in another record today. So this is really now the standout among the largest cap tech stocks in terms of the performance year to date. Alphabet has kind of pulled ahead of the others. That's something to keep an eye on. We've also been continuing to watch what's going on in the crypto market. Bitcoin's losses accelerating to the downside here as we see it break below 85,000. A little bit of a bounce off the lows of the past 12 hours, but nonetheless still taking a hit in today's session. By the way, we also just got University of Michigan November consumer sentiments, the final reading for November, coming in at 51. The estimate was for 50.6, so very slightly better than had been estimated. And then finally, also want to take a look at what's going on with retail stocks because we continue to watch what's going on in that space, both earnings this week and earnings last week. Oh, we're still at the year to date there. Let's switch it back to what we're seeing on the day. And so we have mostly gains here in many of these retail stocks. I'm looking here for Gap up on my screen. I'm not going to see it, but I'm going to talk about it right now, and I'm sure that we're going to show it. Gap is raising its full-year forecast after topping third-quarter expectations. The retailer is getting a boost from its Better in Denim campaign, with comparable sales up 5% year over year. Going to send it over now to our executive editor, Brian Sozzi, who's talking to the CEO of the Gap, Richard Dickson. Soz?
All right, thanks, Julie. Richard, always nice to see you. Let's start on this Gap division, because now you're stacking wins on top of wins, positive sales on top of positive sales. Zoom out for us. What is the one big factor that is allowing you to do this?
Brian, it's good to see you. Look, I think it's clear our strategy is working and it's showing up in the momentum of the business, and we're seeing it in results. To your point, we've had consecutive quarters of consistent positive comps. This is our 7th consecutive quarter. We were up 5%. Net sales up 3% over last year. Our brands are performing. Old Navy delivered an outstanding quarter. It's our largest brand. It was up 6%. Gap up 7%, and that's on top of 3% from last year. It's 8th consecutive quarter. Banana Republic up 4%, second quarter in a row on comp. Gross margin exceeding expectations. So look, we are incredibly proud of our performance. The playbook is working, and with another share of gains, our brands are winning where it counts, and that's with the consumer.
Help us understand what you're seeing from a consumer standpoint, Richard. This week we have Walmart saying lower income and higher income people are coming to its stores for food that is higher priced. TJX, of course, Marshalls and Home Goods, they had a good quarter too as well. How are they, where are they getting this money, Richard? They can't afford to shop in all these places.
It comes down to a few really important aspects: product, storytelling, execution. We're seeing great strength in our customer behavior. We're winning with all income cohorts, and you can see it with the differentiation in our portfolio. We see equal growth across low, middle, and high. And this is evidenced by the two biggest brands in our portfolio, Old Navy and Gap. We do see external data points that suggest there's macro pressure on the low-income consumer, but our customers are finding our price, our value, our style, our quality, our narratives, our store experiences. They're breaking through the competitive landscape. We've had less discounting, better regular price sell-through. We've increased our average unit retail. That's indicating that our product is resonating. We're also excited to see the high-income consumer discovering our fashion, quality, and value, and we attribute this to the narrative that we're putting out there in the context of cultural relevance and marketing. Our portfolio appeals to a wide range of consumers, and it gives the Gap Inc. portfolio great flexibility in today's environment. We have a stronger portfolio today than we have in the past. Brands are resonating with consumers, and we're looking forward to a strong finish to the year.
Is the reality that styles, Richard, have just changed at some point this year pretty markedly? Wider leg pants, how things fit and feel are a lot different, that people just do not or did not have this stuff in their closet?
People always want fashion and to be on trend and relevant. And I think today, when you look at our brands and compared to where we were in the past, we've always been a reliable place for basics. And now what you start to see is we've sort of surround sounded it with great fit, function, feature, innovation. The product presentations look really strong. Our denim collections across our brands, but of course, particularly Gap, has been outstanding. Fleece. We've gotten really innovative with different fabrications, bounce fleece, various different ways that we've expressed innovation, and even sleepwear. Gap is driving a sleep to street concept that is working incredibly well. Customers are always looking for style, but most importantly, quality and value, and clearly our brands have it all.
When you first took over this job, Richard, I thought, and I told you this, I thought you were going to close hundreds and hundreds of stores. Now, I would say you have prune stores. But you mentioned this in the earnings call last night regarding the Gap division, that you're at a pivotal moment for the store base there. What does that mean, and what is next for the store base for Gap?
Stores are incredibly important to us, but what we really think about is our consumers, where they are, where they're going, whether it's in stores or through a digital dialogue. And we're focused on cultivating what I would say is the best experience across every touch point that our consumers are in. So when we look at our fleet today, we have a very strong fleet of about 2,500 doors. We are at a pivotal point. We have been pruning and optimizing our retail footprint. We're now in a precision point where we're looking at new concepts, new doors, refresh models, and we believe that it's going to be an exciting chapter. We're always optimizing our retail footprint. We're always looking at repositioning, in some cases, on locations that we believe are more relevant to our customers. We're evaluating new store openings. And last year, I think we closed about 56 stores across our portfolio. We probably have another 35 this year. And now we're at a really exciting point where we believe we've got some incredible opportunity for growth from a store perspective, and certainly our online business has been performing very well.
You said something very interesting also on the earnings call last night, Richard, that I haven't heard from you before. You said you are in the final stages of fixing the fundamentals. Then what will define Gap's 2026?
Yeah, Brian, well, you've been on the journey with us. We defined what we call our transformation roadmap in 3 phases. The first phase was fixing the fundamentals. And fixing the fundamentals is really about our strategic priorities, financial and operational rigor, just running the business better, reinvigorating our brands with our playbook that's starting to generate cultural conversation and traffic to our stores and our sites, strengthening our platform, supply chain, tech, HR, legal, finance, and energizing our culture. As we finalize, if you will, these stages of fixing the fundamentals, and the metrics are proving that we've done that and we still continue to work on that model as continuous improvement, we now move on to the next phase, which is about building momentum. We've got the momentum now in our brands and our portfolio, and now we're going to continuously improve to drive consistency in that deliverable, getting to our third phase, which is accelerating growth. So while we're in this building momentum phase, which is about continuous improvement, we're seeding high potential opportunities that will enable us to accelerate growth for the long term, including high margin, traffic, driving categories like beauty and accessories, and lots of new concepts that we're working on behind the scenes. But a very comprehensive, phased approach. We're entering that build momentum phase with a lot of energy and a culture that's really excited about what we can do with it.
Lastly, Richard, how will you spend your Black Friday? And are Black Friday and Cyber Monday, are these still needle-moving days for a company like Gap?
Absolutely. They're really important days. And by the way, every day leading up to it is an important day in retail. We're off to a great start. I will be in stores. My leadership team will be in stores. We'll be active with our customers and experiencing that firsthand. We've got a lot of exciting activations that are planned for the holiday season, even more exciting releases that will come soon. I'm really excited about certain categories. Denim continues, fleece, sleepwear, marketing is fantastic. Brian, go online. I know you do. Our brands look fantastic. Products are great. And ultimately, we're there for our customer. I don't know if you recently saw Old Navy did a partnership with DoorDash, which again is really a thoughtful consideration, recognizing we want to be everywhere our consumer is. And it provides convenience for tens of millions of users. Stores are ready, teams are ready, we're ready. We look forward to a strong finish.
Well, you sound ready, and if you are in Long Island, drop me a line, Richard. I want to go tour a store with you and have a little fun. I still like doing that stuff. Richard Dickson, happy Thanksgiving. We'll talk to you soon.
Brian, thank you.
All right, Julie, back to you.
Where will I be on Black Friday? We'll have to talk about that, Soz. Thanks so much to Richard Dickson and to Brian Sozzi. Coming up, we're going to break down what the market technical signal for stocks after a turbulent week for financial markets. We'll be right back. The S&P 500 has closed below a key technical level that could mean more losses ahead. The benchmark index broke under its October lows following a market whipsawed by AI valuations and rate expectations. Joining us now, Adam Turnquist, LPL Financial Chief Technical Strategist. Adam, it's good to see you. We're talking about the 50-day moving average. Of course, we've been talking about it a lot lately here at Yahoo Finance. Given the 50-day moving average that we've been watching so closely, add to that the sort of reversal that was very unusual that we saw in yesterday's session. What does that tell us about what will happen next?
Well, when we look at the market and the sequence of events that have transpired over the last several weeks, we've had deteriorating market breadth. That's not always a great timing tool, but it does matter more when you start breaking down support. It's just evidence that there's less structural support for the market. We took out the 50-day. We've had momentum diverging with price action, suggesting there's a little bit of buyer fatigue setting in. So now we're hovering right around the October lows. The level to watch, 65.50. I think if the S&P can close above that level, we'll call it a win given this week. But if we break that 65.50 level, there's a decent pocket of air to the downside here, potentially 6,200, maybe even the 200-day moving averages in play, or those February highs around 61.50.
And when you combine this with sort of the action that we're seeing in the VIX, because I was seeing some commentary this morning that people had really been buying calls in size going into NVIDIA's earnings, for example, so they were set up for more gains that didn't necessarily work out. So how is that translating to overall index volatility? And again, what does it tell us about what happens next?
For volatility, it's certainly come back with a vengeance, especially yesterday with the VIX spiking higher, 28 in change on the intraday high. But when you go back through history all the way to the inception of the VIX and you look at what levels actually matter, and those levels are generally on the intraday high. So we looked at every single trading day on the VIX going back to 1992. What are the intraday highs and what are the forward returns for the S&P 500 over the next 1 to 12 months? What we found is that the capitulation requirement or threshold is really you need to see a VIX go above 30 on an intraday high basis. That's what's resulted in meaningful or significant above average returns for the S&P. Everything else in the middle is kind of in line with average, even in the 25 to 30 range. It's really that capitulation at above 30 that historically has spiked or has been a signal for kind of peak fear in the market.
So none of this sounds great in terms of, a potential gain or rally before the end of the year, Adam?
We'll see how it plays out. We'll take it one support level at a time. Again, those October lows are going to be important, but I think you have to step back, and even if you take out all the technical signals, we've had a 40% rally on the S&P 500 in about 7 months. So a 5 to 10% type drawdown, that just comes with the territory of this type of price action. When you have these parabolic moves, you should expect at some point the bull market is not linear and you're going to have a drawdown. So the technicals right now tell us that there's elevated risk for a deeper drawdown. Again, I don't think it's the end of the bull market. Maybe a pretty good buying opportunity if we get down to the 200-day or kind of those February highs, especially as we go into year end. We'll see how it plays out over the next several weeks.
Adam, how are you thinking about what's participating both to the downside and upside when we see these moves? Obviously that 40%, move that we saw, a lot of that's large cap tech, but a lot of the downside has been large cap tech. So what are the sector moves telling you?
Yeah, certainly tech has been a leader on the way down into April, on the way out, and now it's starting to lead a little bit on the way lower. What's been really interesting, if you look back over the last 7 months, we've had pullbacks, minor ones at that, but the rotations in the market, maybe big tech takes a breather, have been more in financials, industrials, even consumer discretionary for a little bit. So it's really been more cyclical in nature. What we witnessed in the last several weeks is the market taking a little bit of a breather in risk appetite. We've had healthcare, energy, and utilities actually starting to show some relative strength. That's a new sign in this recovery period we haven't seen, and I think that leadership turning a little bit more defensive does speak to the risk that we could have less risk appetite in the market right now.
Adam, I also want to ask you about crypto because the action there has been so interesting. Obviously, it's been pulling back, but then we had the action on October 10th, but then we also had this morning sort of an accelerated bout of selling. So how do you analyze the levels in crypto the same way that you do in stocks?
Yeah, absolutely. I think when you look at crypto, for at least me, it's hard to come up with a fundamental valuation. So we just look at price. Where's trend? And the trend started to break over the last month. We had it break this uptrend, drop below the 200-day moving average. Now we've had this 30+% drawdown. We're getting close to the April lows around 74,500. I would look for maybe a potential relief rally there. Bitcoin very, very oversold. When you look at the relative strength index or RSI, it's I think down to 22. That's a multi-year low. So wouldn't be surprised to see a little bit of a temporary relief rally and just maybe some consolidation for Bitcoin going forward. But certainly we look at it as a measure of risk appetite. And even yesterday's price action, you had Bitcoin rolling over ahead of the market, then went Nvidia, then went the S&P 500. So we look at it on a shorter term signal just to give it a broader reading on where maybe risk appetite is.
Well, that's really interesting because in other words, do you see crypto as sort of a leading risk appetite signal, or do you see it more as lagging, or it kind of depends?
I think you have to go with leading right now, and that's how it's been acting over the last several months. It's obviously higher beta, and we tend to see Bitcoin, I mean, at least in this cycle and this pullback, it was certainly leadership. We had this failed breakout, as I mentioned, a trend line violation. The Nvidia and the rest of the selling pressure in the broader market took place after that. So it was a warning. And it also aligns with some of the positioning in the retail space. They started to de-risk over the last few months in the positioning data that we look at. That was another unique thing that hasn't occurred over the last 7 months. We've had retail stepping up to buy the dip. Last few weeks, they started to de-risk even before this week's price action.
Yeah, it's been interesting to say the least. Adam, thank you so much for joining us with your perspective. Appreciate it.
All right, thanks, Julie.
Jeff Smith, Starboard Value Managing Member, CEO, and Chief Investment Officer, joined Yahoo Finance Invest to discuss activist investing. Among other things, he talked about the results of his firm's legendary takeover of Darden in 2014, as well as current campaigns on Wall Street.
Immediately upon winning the contest and replacing the entire board, which is the only time it's ever been done for a Fortune 500 company. I don't think it'll be done again. It shouldn't have been done then. I mean, there should have been a settlement that was done beforehand, but the board didn't take any action. There was a lot of pressure. This was a seminal moment, if not the seminal moment in activism, in that there were no excuses. Darden was either going to be a really good story or not a good story. And there were people on both sides rooting for different things. And I felt that. So the governance community and activists and shareholders that wanted companies to be more efficient were heavily rooting for us to perform really well. And there was a whole group of people on the defense side as well as corporate executives that would have loved to see it not go well and to point to that and say, see, that didn't go so well, activists aren't great. So from my standpoint, we went into that boardroom. I still remember to this day the conversation I had. I became the chair of the board and standing in front of the board and saying to the board, okay, we did something here that's historic, but it's just the beginning. We have to execute. We have to perform. We have to do something great with this company. This is incredibly important for the future of the markets.
I think the first time I talked to you was on the day that you had hired Rob Lynch over at Papa John's, and it was a campaign that you did at Papa John's. You led as chair at Papa John's. Both of you got the business going in the right direction. Rob's now at Shake Shack?
Shake Shack, yeah.
Leading Shake Shack. Papa John's has been the news of late. A bungled deal process or whatever's going on there. Would you want to get back involved with Papa John's? Because after you left, something happened, Jeff. They just fell by the wayside.
I love Papa John's. Well, look, Yahoo has a warm place in my heart. I was on the board of Yahoo years ago. Papa John's has a warm place in my heart as well. We did some great things at Papa John's. We improved the business tremendously. We changed the perception around the brand. We introduced stuffed crust pizza for Papa John's. It's delicious. It's amazing.
It is good.
The Papadillas.
But you also got Shaq on the board too, as well.
Yeah, look, Shaquille going on the board was fantastic for the brand, and he's a terrific person and super smart. So that was great as well. I love the company. I would never rule out getting back involved. I think there's a lot of opportunity at the company, but it has to be right for both people and it has to make sense.
All right, I want to take through some other companies. You were also involved, that we covered really closely here, in Salesforce. Now, Salesforce went through a period of time after you really got involved on trying to improve their profit margins, and they did. But now it looks like they're back out making big acquisitions. The profits have been a little under pressure. Concern about if AI will eat software. What do you think about that company?
Salesforce is great. Terrific company. I think they're going to be an AI beneficiary. They are still focused on their profit margins. So they report each quarter not only their revenue growth, but they report out on their profit margins. And Mark Benioff is pretty excited about the improvements that have happened. You know, when we got involved, we were talking about them improving their Rule of 40 score. So that's revenue growth plus profit margin. And the Rule of 40 score has improved materially. So they have done a really good job at managing the business. The performance has been much better from the beginning of our engagement to now. The multiple has come down. So it's not an execution issue. It's, as you mentioned, software in general has been more under pressure, especially value software, which are companies that aren't growing 20+%. They're growing double digits, but it's not as high as other people would want. So we feel really great about it and think it's a terrific position for us, and the company's going to do well.
Okay, next up, Kenvue, just inked a deal with Kimberly-Clark, $48.7 billion. You were involved with Kenvue. Do you like that deal?
I love the deal. I absolutely love the deal. So Kenvue, we got involved in Kenvue, amazing brands, the best brands in consumer health. So Aveeno, Neutrogena, Band-Aid, Listerine, Sudafed, Motrin, and then Tylenol.
All the stuff in our closets.
And then Tylenol. And it's amazing. The brands are absolutely amazing. Kimberly-Clark, also amazing brands. Huggies, Kleenex, amazing brands. I think what people don't exactly understand about this combination, and I think they will. I think they're overly focused on what's going on with Tylenol and acetaminophen, but is that the org structures are similar. So actually both businesses are organized where they're run by geographic P&Ls. And to some degree, they're limited in their degrees of freedom because each one of those geographies has to have enough scale to be able to operate. So by merging these companies together, nothing's easy, but it's a fairly easy integration in that you're actually merging two org structures together that overlap beautifully, in that you can put more products, more brands in each geography. And by doing that, you get more scale advantages in each geography, and also gives you more degrees of freedom to be able to prune the portfolio and take out the smallest SKUs with the lowest volumes, or even the smallest brands. It's kind of a nuts and bolts piece of the inside baseball of how companies operate and what happens, but the fit together of Kimberly-Clark and Kenvue is probably better than people think it is. It's really a very good transaction.
Key to unlocking, I think, the ultimate value of that deal for Kimberly-Clark, though, is how do they regain confidence or trust in Tylenol as a result of all these autism concerns?
Well, let's go back one more step, though. So the other thing that had to happen at Kenvue was an improvement in digital marketing and newer marketing, and Kimberly-Clark has also embarked on that transition, and they're further along than Kenvue was. So we're also expecting that they're going to be able to speed up our process at Kenvue, and combined there'll be a better marketing effort, especially for what should be the faster growing skin health and beauty brands. As it relates to acetaminophen and Tylenol, I don't know that there's a big change that we're seeing in brand trust as it relates to the actual sales. I mean, the business is fine. The business will be fine. This is a brand that's withstood other things that may have been even worse than this. And I think if you look at what's been put on the Kenvue website, there's a lot of information out there about why the company and many key opinion leaders and experts would say that Tylenol and acetaminophen is safe. So I think consumers know what they want to take and what they want to use in their closet or in their pantry or in their medicine cabinet, as you mentioned. And I think they feel comfortable with Tylenol.
Coming up, we're looking at some of the top calls and today's trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today, we're watching shares of Walmart, Bath & Body Works, and Cracker Barrel. First up, Walmart. That stock got an upgrade from both Davidson and Telsey Advisory Group. Rather, they both raised their price target on the stock to $130 per share. After the company beat estimates in its latest report, Joe Feldman over at Telsey Advisory Group said it expects Walmart to remain a leader and market share gainer in the retail industry, given its defensive value price product mix, strong focus on the customer and technology, including AI, plus what he calls robust financial flexibility. Next up, we're watching shares of Bath & Body Works. That stock seeing a sharp fall for the second day in a row as downgrades pile up from firms like Morgan Stanley, Telsey, Goldman Sachs, and Baird after it missed Wall Street's expectations, and it also shared a turnaround plan in its quarterly results, but many on the street fear that this turnaround plan will take longer than expected. And last up, Cracker Barrel. That stock seeing a pop today, even after some bearishness on the street. Citi analyst John Tower cut his price target on the stock to $24 from $42. That stock now around $27. And in a note to clients, John Tower said that he expects same-store sales to miss expectations on that still troubled foot traffic, following the backlash it got to changing its logo, plus the pullback from consumers that's just hitting the overall industry restaurant space. Now, in the past 5 days, the stock, keep in mind, is still down about 7% as investors digested the company's decision to keep Julie Feltz-Messino as CEO. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We're watching Eli Lilly, BJ's Wholesale, and Ross Stores. First up, Eli Lilly, the company notching a major milestone, reaching $1 trillion valuation. It's the first healthcare company to ever reach that market capitalization. Investors are betting on the drug maker's weight loss medications for a market projected to reach $95 billion by 2030. This is the company behind Mounjaro and Zepbound. It's climbed 37% so far this year after a 32% rally in 2024. Next up, BJ's Wholesale. The retailer posted better than expected earnings in the third quarter, along with revenue that came in line with Wall Street's estimates. It's also boosting its earnings forecast. BJ's benefiting from an increase in annual membership fees that went into effect earlier this year. However, its profit did slip as expenses increased. It also narrowed its outlook for full-year comparable club sales. And finally, Ross Stores, the discount retailer, raising its earnings per share forecast for the full year. The improved guidance came in above the average analyst estimate. Its third quarter's comp sales also came in well above estimates. The discount chain benefiting from an increasingly price-conscious consumer. It's also insulated from tariffs as it purchases unsold goods from retailers who are grappling with the levies. This week, we saw its competitor TJX also post strong results as shoppers search for deals. Coming up, Intuit CFO on the company's new $100 million partnership with OpenAI and the outlook for the coming year. We'll be right back.
Absolutely. It's Sandeep Aujla. Absolutely.
Intuit, which makes tax and business software, including TurboTax and QuickBooks, reported stronger than expected results for its fiscal first quarter Thursday, which gave the stock a 7% bump at the open, its biggest since May of 2023. The shares are right now up 4.5%. By the way, it also this week, signed $100 million partnership with OpenAI. Joining me now to break all of this down is Sandeep Aujla, who is the Intuit Chief Financial Officer. Sandeep, it's good to see you. Just sort of talk me through the quarter here and what you think were some of the big drivers for the beat in terms of those numbers.
Well, first of all, good morning. Thank you so much for having me. It's been a very exciting week. The quarter was driven by the strong momentum we had coming into the year from fiscal 25. driven by the consistency of our strategy, focusing on what matters most to the businesses and the consumers we serve, and the strong execution across the company. We saw our business platform grow 18%, our consumer platform grow 21%, delivering a strong 18% growth at the overall company level. And you saw the strong guidance we set for the quarter ahead, which is bolstering our confidence in what we think this year will turn out to be like.
Sandeep, we've talked about this a little bit before, but just for folks who perhaps didn't catch the last conversation we had, people who think of Intuit primarily as a tax software company, you guys offer a lot of other business services. Is there a way of sort of quantifying how much of your revenue you're now getting from exclusively tax services versus the bigger suite of sort of business services?
Great question, Julie. The way we think about Intuit is a fintech company that is serving 100 million customers across businesses and consumers. About 60% of our business is serving small and mid-sized businesses. About 30% or thereabouts is on the tax business and about 10% on Credit Karma. So 60% business, 40% consumer-oriented. And the company has really been focused on delivering areas that matter the most to our customers across done-for experiences using AI and human intelligence, being at the center of money decisions for these customers. And we are now focused increasingly on going upmarket, as traditionally the company largely served the smaller of the small businesses and the consumers. That's the evolution that's been going on at the company over the last decade plus. And Julie, what I'm really excited about, particularly in this era of AI, is the company's foresight, that we are always thinking about what's going to be the most relevant in the years ahead. And the fact that we've been executing on our AI-driven expert platform strategy since circa 2018, way before it became fashionable to talk about AI across tech and the investment community.
And I know that AI is helping your business clients in particular. They can query it as to how to improve costs in the business, for example. In terms of AI and the tax preparation, how much is it being used in that? And sort of what's the back testing, or what's the testing of it? In other words, what if the AI makes a mistake on doing your taxes? What's the sort of system in place to make sure that doesn't happen?
AI is at the core of the fabric of everything we do for the consumer and for the business. On the consumer side, as we think about the tax experiences, AI is helping guide the experience from understanding what the situation is. So we can take each customer through a very bespoke tax preparation experience so they walk away with the utmost confidence. As a company, we have about 70,000 attributes per consumer. So we use that to understand what the likely tax situation is and what the right set of questions to ask so the customer has every deduction that they're entitled to and they don't pay $1 extra in taxes. And in terms of the accuracy of the AI is helping make the decisions in terms of the workflow. It's been tested across millions of customers. At the end of the day, we also continue to unpack our logic and provide the agency to the customer. I'll give you an example. For example, on the business side, we rolled out 5 agents. Our accounting agent is helping customers save up to 12 hours a month. And this is something that the customers are telling us. 45% of them said, it's saving me 12 hours a month. That's a day and a half that they earned back in productivity. And this agent does the work for them and unpacks, here's the decisions I made. And the customer could either confirm it or change it. And if the agent made a mistake in the rare instance, it learns from the customer's correction and improves its accuracy going forward. We feel really good about the accuracy of the agents, as well as the fact that we're putting the agency about the final decision in the hands of our customers.
Let's talk about the OpenAI partnership, because I'm not entirely clear on how it works, right? So if I go to ChatGPT, how does that then, what will get me to Intuit, right? Is it just sort of Intuit's advice is integrated into ChatGPT? How does that all work?
So you have hundreds of millions of people going to LLMs every week to go get advice on whether it's financials or other areas. OpenAI itself has about 800 million weekly active users. So we are super excited about the opportunity to highlight our platform to these users and have our platform be where their eyeballs are.
But again, like if I'm going to ChatGPT and I say, I want to put all my tax information in there, or I say, here, can you help me do my taxes? Does it then take me to an Intuit link? Does it just incorporate the Intuit advice? How does that work?
So today, the way people are largely using LLMs is asking them questions such as, I had a car breakdown and it's about a $2,500 repair. What are my options? What should I do? And today they're getting very generic answers such as, oh, you could put on a credit card, you could go get a personal loan, etc. As we work together and through our partnership, we will be giving very specific, actionable actions to the customer based on their specific situation. So when you go in and you query ChatGPT post our partnership, you will have the opportunity to then connect into the Intuit platform, link your account, and based on your specific situation, for example, we will know, hey, Sandeep, based on your tax situation, you are likely to get a $3,000 tax refund. So instead of recommending go put it on a credit card, go get a personal loan, we will suggest, let's get your taxes done. Let's get you into TurboTax. They'll come into our platform to do that tax filing. Or here are the TurboTax experts that are local to you. Let's get that filing done. In essence, we're taking LLMs from a generic financial advice to a very specific financial advice unique to your situation, and thereby making it very tangible and very much actionable as we move forward.
Gotcha. Okay, Sandeep, you mentioned tax refund. So I have a question for you. Going into next year, because the One Big Beautiful Bill will be taking more of an effect, how much are you guys expecting clients to get in refunds as a result of some of the changes in that bill?
We think the One Big Beautiful Bill is going to be a tailwind to the U.S. economy, is helping the consumer. One of the unique aspects is that the IRS did not change the withholdings this past year after the bill was implemented. That would result in our expectations that many more people than usual would end up getting a refund in their taxes in the year ahead. So that should be good both for our business, but also good for the U.S. economy, as there'll be a new infusion of capital in the hands of the consumers to work across the economy.
Sandeep, thank you so much. Great to see you. Appreciate it.
Thank you, Julie. Likewise, thank you for having me.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. All right, let's get a quick check of the markets here because we see a mixed picture. Of course, we've had a recent sell-off among mega cap AI, and that sell-off might put a scare in investors with positions in big tech. Our next guest sees it as a healthy rotation, but a signal that we may be far too dependent on a handful of mega cap AI names. Let's bring in Matt Powers, Powers Advisory Group Managing Partner for this week's FA Corner, brought to you by Capital Group. Matt, great to see you. So, how many calls? Is your phone ringing off the hook from people who were spooked by the sell-off and wondering what they should do with their large cap tech holdings now?
Yeah, Julie, thanks for having me. Yeah, I'm getting the question a lot. So, I don't think this is 2000 all over again, but I do think the biggest risk we have, it's concentration. It's not volatility. We're seeing a normal rotation. It's just a normal, healthy, overdue rotation in the market. And after 2 years of extremely concentrated leadership. So, the last couple of years, the story's been the same. The top 10 stocks in the S&P 500, almost all mega cap AI names have made up around 40% of the index and, driven the majority of the return. So when one of those names wobbles, it's like the entire market does. And NVIDIA is the best example of that right now. We just saw that yesterday.
So is your message to clients then maybe don't have so much concentration in those stocks?
Yeah, and you can almost bring that right back to NVIDIA because that's kind of the poster child of this right now. We all know that. And just yesterday, Wednesday, huge revenue growth, guidance raised. Jensen basically came out and said there's not an AI bubble. They see something totally different. But you could almost feel the relief there. And AI stock, they bounced at first, and everyone's thinking, okay, crisis averted. But we saw how quickly that turned. But here's what worries me. On the flip side, if that report had gone the other way, if guidance had been soft, if CapEx commentary cooled off, you'd be talking about a totally different tone into year end. And I've been doing this over 20 years, and I honestly can't remember another time where one company's earnings call had this much power over, how investors feel over the entire market. And that kind of reliance on a single stock, I think, it's just dangerous. And it's fine when it's working, not great as a risk setup. So what we saw yesterday, I really think it's just the market, with NVIDIA turning midway through the day was really just a classic sign of investors move away from those high valuation names and pulling some risk off the table. And, in other words, they just don't think investors are abandoning tech right now. They just stopped chasing it and maybe decided to dial back the risk.
And you see what's happening right now as a rotation, not sort of a collapse in AI. So what are you seeing that indicates that to you?
Yeah, I'd call it a rotation. It's parts of the market that were completely ignored are finally starting to wake up a little bit. And to me, that just signals some normalization. It's not a bubble popping, because, I think if this were a bubble bursting, you'd see a correlation spike. You'd see everything selling off together. But what we're actually seeing here, I think, is some broadening. In this past week, tech and the NASDAQ, we know, pulled back, but under the surface there, you saw staples and healthcare have started to outperform, and they've been lagging for a long time. Exactly what you should see after a couple of years like we've had. So no, I don't think the AI story is dead, like I'd said before, but I also don't think you want a portfolio that lives or dies on basically 7 names, or 1 name for that matter.
It's interesting because you do have a pick that you mentioned to us that's still a tech name, but sort of a different kind of tech name, and that's Palo Alto Networks. How do you think about that in terms of how it's situated in a portfolio?
Yeah, we kind of say we're playing defense within equity, so it's not like we're shifting to cash with clients, but we still like tech. It's just when it's a way to stay with Palo Alto, it's a way to stay in tech, but in a much more defensive lane, and they took a little bit of a dip in price, so it makes a buying opportunity for them. But cybersecurity, it's one of the last IT lines that anybody's will cut, and we're in this world with more cyber attacks. There's more ransomware, more cloud and hybrid work, and security's gone from one of those things that's just kind of nice to have to it's necessary at this point, and they're the leader. And they've been growing nicely. Revenue was up mid-teens year over year, and in their next-gen security business, which is cloud security and some of their AI-enhanced tools, which they're leaning into, is growing even faster. So not a cheap stock. It doesn't hit that valuation thing that I'm talking about. But in our view, it's just a good core long-term holding. And if you want tech exposure without betting the farm on AI CapEx staying where it's at, Palo Alto is a good way to do that.
And Matt, just quickly, how many of your clients have crypto in their portfolios, and are you recommending they make any changes given what's been going on there?
Yeah, little to none as far as clients that own them personally. Yes, I do. We know that it trades like high beta tech, and when investors pile into growth in AI stocks, Bitcoin usually rides alongside, and in the exact opposite. But we just saw this yesterday, not to go into depths on it, but it was leverage yesterday. There's heavy leverage, it's trades 10, 20 times, even more. And so when the price breaks some of these key levels, those leverage long positions get automatically liquidated. And, so yesterday was exactly that. Bitcoin slipped, leverage unwound, liquidation snowballed, that move. So I don't think necessarily we're just seeing, crypto being sold, I think, or Bitcoin being sold. I think yesterday was the leverage machine was just kind of kicking in there.
Right. Matt, good to see you. Thanks a lot.
Good to see you.
Thanks. That was FA Corner, brought to you by Capital Group. And we'll be right back with full market coverage ahead in the second hour of Market Catalysts. Minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. As we look at the major averages here today, we're seeing some wavering, particularly in the NASDAQ, which started out the day higher. It's now off by 1/3%. The S&P 500 wavering as well right now, just up about 0.1%. The Dow is hanging on to its gains, up more than 200 points. Now remember, as our Jared Blickery mentioned earlier, it is witching day. That is expiration of futures and options contracts. That can cause some volatility with the session, and obviously it's already been a volatile week, particularly for large cap tech, and we saw that big reversal in yesterday's session. So it's going to be really interesting how the rest of the day plays out. It's not sort of consistent through the session. Well, speaking of volatility, it's been a rough couple of weeks for Bitcoin as well. The cryptocurrency on track for its worst month since the crypto collapse of 2022. Are we close to seeing the light at the end of the tunnel? Well, we'll see. Joining me now is Zach Pandl, Grayscale Managing Director of Research. Zach, it's good to see you. So are we getting close to the bottom here? What signs are you looking for?
Hey, Julie, great to see you. Look, I think we are likely getting close. I think value has opened up in the space in a variety of ways. We are seeing stabilization in some of the things that have been driving the market. But crypto really has been weighed on by a shift in macroeconomic expectations, shift in expectations for the U.S. policy outlook. I think a few months ago, we had a booming U.S. economy combined with Fed rate cuts. Now there are questions about the health of the labor market and about credit markets and uncertainty about where Fed rate cuts may be heading. It's really been that macroeconomic shift that's weighed on crypto. The crypto industry itself in very solid shape from a longer term standpoint. I think we'll be through some of this macroeconomic uncertainty relatively soon.
Okay, so I have a lot of questions about this. First of all, New York Fed President John Williams spoke this morning, and he indicated that he would be open to a Federal Reserve rate cut in December. Stocks bounced off of that. Bitcoin bounced a little, but didn't recover. So if indeed Bitcoin has been tracking to these rate cut perceptions, why didn't we see more of a positive reaction there?
Look, it's, of course, bigger than any short-term move. I would say this. You have a jittery crypto market because of concerns around a concept of a 4-year cycle. Crypto was an early-stage industry and asset class for the last 15 years, and it appeared, anyway, to follow a 4-year cyclical pattern. We've had a 3-year bull market, and so investors that were conditioned to that kind of pattern naturally a little skittish around prices today, concerned about some type of broader top. I think that this is a misguided perception. Cycles don't die of old age. Things that are priced in and well known to the market typically don't move prices. I think it's very clear to me that we've seen a shift in the macroeconomic expectations. That's weighed on crypto. The outlook continues to be very bright. I think we'll see that play out through the numbers and ultimately through valuations over the next few months. So,
something else that sort of confuses me about this current moment in crypto is that one of the arguments for crypto as an asset class, Bitcoin as a thing, was that it wasn't subject to these macro forces, right? That it sort of existed alone as this thing that was outside of the financial system. And it seems like as it's gotten more institutionalized, which is something that the industry wanted, that's no longer the case. Is that fair to say?
It is absolutely fair to say. Crypto is no longer an isolated ecosystem with zero correlation to things that are happening in the broader economy. It's a $4 trillion sort of mid-size alternatives asset class that's in many different types of investor portfolios, and that's going to continue to grow and evolve and change over time. Now, investors look carefully at these correlation questions. And although there is shared ups and downs and similar macro drivers, similar to other commodity markets like oil, crypto also frequently marches to its own drummer. And so this is what makes a good portfolio diversifier. Yes, there's inescapably some beta to broader equity market moves, to the behavior of Fed policy, just like other commodity markets, for example. But there is also a moderate correlation and good diversification benefits for incorporating crypto in a portfolio. So this is the kind of analysis that everybody that is trying to optimize a diversified portfolio goes through. I think that they're not surprised by these recent moves, given what's been happening in the economy, and it's not going to shake their expectations of how to incorporate crypto in the context of a diversified portfolio for the longer term.
Zach, this year we've seen a real boom in digital asset treasuries, right? Companies putting crypto of all different kinds on their balance sheets. With this sell-off and some of the liquidations, for example, even this morning that we were seeing, the speed of the drop, is some of that because these digital asset treasuries are being forced to do some selling when the cryptocurrency prices fall below a certain level?
I would say no, and that is a increasingly common misperception. By and large, there has been virtually no selling by these vehicles. They may do that, they may not. It'll all depend on what is in the best interest of the shareholders of each of these individual names. But by and large, they have not been selling. Really what you have seen is that these assets traded at a premium at earlier parts of this year when there was excess demand from equity investors for crypto exposures in the context of rapidly rising prices. Now, as prices come down, you see some of these assets trade at a discount to the crypto on their balance sheets, just reflecting less demand from equity investors. These are conventional cyclical ups and downs that are common, in crypto's history and also common in every asset market. And I think investors will come to understand this, and these types of structures will be a permanent feature of crypto markets and the right vehicle for certain types of investors. ETFs, private fund structures will be the right vehicle for other types of investors.
Zach, what's going to turn things around here? I guess one of two things can happen. Either the selling exhausts itself, or something positive happens that actually makes people want to come in. Do you see that type of positive catalyst potentially between now and the end of the year?
I do. Fundamentally, the thing that'll change, I think, is more progress on market structure legislation in the U.S. Senate. This has been a huge piece of the crypto story this year. Regulatory clarity driving institutional investment in the asset class. I think we're going to see the ball move further down the field before the year is out. I think that's one important potential positive catalyst to consider for the asset class. From a more technical standpoint, I'd suggest investors focus on ETF flows. The ETF has really been an incredibly popular instrument for all asset classes, but it's definitely in crypto. We're delighted to continue to bring these vehicles to market at Grayscale. And I think keeping an eye on ETF flows is a good barometer for some of the shorter-term market sentiment. As we see some of those flows stabilize, that could be confirmation of a bottom. So I would focus on those two factors: progress on regulatory clarity, ETF flows as potential catalysts that investors can monitor into the end of the year.
We will be watching those things indeed, and we'll catch up with you again soon, Zach. Thanks so much.
Thanks, Julie.
Coming up, a read on the employment picture heading into next year. Indeed is out with its 2026 jobs and hiring trends report, and we'll dive into that next on Market Catalysts. New forecasts from Indeed show that the labor market is likely to see some changes in 2026, with unemployment likely to rise slightly and job openings poised to stabilize. Joining me now with more on Indeed's 2026 jobs and hiring trends report is Laura Ulrich, Indeed Director of Economic Research. Thanks for being here.
Thanks so much for having me.
Man, everybody wants to know what's going to happen with the job market next year, so I'm glad you're here. So give us those sort of top-line findings of what people should expect. I mean, unemployment rising, maybe not a surprise. I guess slightly might be a little bit of a relief. What does slightly mean?
Mm-hmm. Yes, we estimate that it will probably be somewhere between even the range of 4.1, which would actually be a decline from where we are now, to 4.8. But we're expecting it to be around the 4.5 mark in our consensus estimate. And that's really driven by what we're seeing in the overall labor market thus far this year, and some of these trends that we think will be real impactors in 2026.
And the buzz phrase, I guess, if you will, for the job market this year has been low hire, low fire, right? Does that continue in 2026? And kind of what changes in that equation on the margins?
I think one of the things you'll see in our report is that we say from a macro point of view that from that point of view, it may still be this kind of low hire, low fire environment from an overall macro picture. But also what we point out repeatedly in the report is if you dig down into individual sectors and also individual geographies, it's not necessarily low hire, low fire everywhere, right? In those particular places. And so one of the things we talk about is how the labor market, regardless if you're a job seeker or an employer, feels very different depending on what sector you work in and where your feet are planted.
So let's talk about sectors then a little bit, right? Because where the hiring has been happening this year has been dominated by healthcare. And so does that continue to be the case next year? And what kind of other sector trends are you expecting?
Yeah, great question. I wish I had a crystal ball to know the precise answer to that. But what we think we're going to see is a continuation of this kind of tale of two labor markets, where there are certain sectors that do continue to be relatively strong and others that show some weakness. And you can see there in that graphic that, the tech sector has looked quite different from healthcare or even retail. As you mentioned, just month over month, including the September jobs report we got yesterday, there's been strength in healthcare and leisure and hospitality, and weakness in other sectors like manufacturing and professional and business services.
And you also mentioned the geographic picture here. And I thought it was really interesting in the report. You talked about the sort of mid-size or smaller metropolitan areas that on the job front seem a little bit stronger. Give me a little bit more color on that and why that might be.
Yes, great question. And I honestly, we were interested in digging in this partially because I live in the Carolinas where I've seen this playing out in real time. A lot of the economic development that has occurred over the past 5 years has happened in these mid-size or smaller MSAs. There's also been quite a bit of migration to those MSAs over time, to those metro areas. And indeed, what we see in almost every state is that it's actually the largest MSAs that have had the largest decline in job postings, and that these smaller to mid-size MSAs, in many cases, still have quite elevated job postings. So if you look at Georgia as an example on that graph, Atlanta actually has the lowest job posting index, which is 110, which means they're 10% above pre-COVID norms. But smaller MSAs in Georgia, like Macon, Warner Robins, Athens, have much higher levels of job postings. And I think it's important, the growth in job postings has exceeded population growth in those places.
Wow. Okay. So Laura, that would seem to indicate then if you're a job seeker and you're willing to move, that probably gives you an advantage.
Absolutely. I mean, I think the job market very much depends on where your feet are. If you're in Greenville, South Carolina, if you're in one of the mid-size MSAs in Texas, there are still ample job opportunities, certainly, especially in some sectors like healthcare, like in advanced manufacturing. And that job picture looks very different than in some of the largest MSAs. And a lot of that is because of diversification of sectors.
Some of the other trends that I know you've been watching the effect of the immigration picture, and this is obviously something that economists have been sort of wrestling with, the supply versus demand issue when it comes to immigration. You guys have also been looking at the postings in terms of which employers are looking to offer people visas, for example. So what have you been seeing?
I think what we found there is very interesting, which is actually employers willing to sponsor immigrants through visa programs. That interest has not declined. So employer interest to recruit foreign workers has not declined. However, on the labor supply side, we are seeing interest from international job seekers in U.S. jobs decline quite a bit this year.
And then you also were looking at federal workers, right? We know there have been a lot of federal cuts. That had been a strong area of hiring in the past. So what are those folks looking for jobs then outside of government? Are people still looking for jobs in government? How's all that playing out?
Great question. So the federal workers picture is an interesting one because, the timing of it has hit the job market in different waves. For example, we'll see a lot of federal government layoffs in the October jobs report because so many took the deferred resignation programs. So we're still not done seeing kind of the bleed from federal workers. They're looking for jobs all over the economy. I think one thing that is interesting as well is that not only has that impacted the federal government workers directly, but it's also impacted some other sectors that are highly dependent on federal funding. So that goes everybody from the large contractors that rely on a lot of federal government funds, but also one of the largest declines, actually I think the largest decline year over year, the sector that's seen the biggest decline in our data is the scientific research and development sector, which is heavily reliant on federal funding.
Laura, as you're saying this about the government workers in October, if they took that deferred resignation, we're not getting a jobs report for October. So will that though show up somehow in November? Like, how will we get a fuller picture of what happened there?
So they have announced that they will release payroll employment for October. There will not be an unemployment rate or a labor force participation rate, but the employer survey will be released. So we will get that data when the November data is released in December. That'll all come out together. Gotcha. I do think, though, the methods of collecting that data is going to have to be different. So we'll see what happens with that. But we would then just see a very large decline in November if those October numbers aren't complete. So there's going to be a lot to watch on that front, but I believe there will be a very large loss in federal government employment in this next jobs report due to the deferred resignation.
We'll keep an eye on it for sure. Laura, thank you so much. Really appreciate it.
Thanks for having me.
All your markets action coming up, including some of today's trending tickers. Stay tuned. You're watching Market Catalyst.
Back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's get a quick check on the markets because we're about 2 hours into today's trading session. And what we're seeing is all three major indices trying to hold on to some momentum that we had at the open. Right now, the Dow leading the way, up nearly 0.6%. If you could take a look there, intraday trading, we saw that pop at the open, and that's after New York Fed President Williams sort of indicated that we could see a December rate cut. That led to some optimism at the open, and now the NASDAQ and the S&P 500 trying to hold on to that momentum as well. The S&P 500 up against that, up nearly 0.4% after we got some downward sentiment around 10 a.m. about consumer sentiment. It was better than expected, but it's still near record lows. And so investors trying to assess that, trying to assess earnings, as well as the key AI trade and what exactly this will mean. And with that in mind, I do want to head right to our heat map when it comes to semiconductors, because we're seeing a broader sell-off there. NVIDIA, Broadcom, AMD seeing downward momentum this morning. We also have Taiwan Semiconductors and Intel seeing some downward momentum as well. And NVIDIA was a key report on Wednesday night. You could see we did see a pop at the open on Thursday, but then as investors sort of made way and tried to assess what this will look like towards year end, we did see that sell-off continue. It's down around 6% over the last 5 days, down around 5% the last 10 days. And over the last month, as this AI bubble risk conversation has gone on, we've seen just a bit of downward momentum, down about 1.6%. But now, as we're seeing this broader risk-off environment, we're also seeing that flow into cryptocurrency, Bitcoin, Ethereum, Solana, all seeing downward momentum as we make our way into today. And as you can see here, year to date, the momentum that Bitcoin and the gains that it's had year to date have since been pulled back. That cryptocurrency is down around a 12% year to date. But I do want to take a look at the Dow because it's a bit of a different picture here this morning. We're seeing Apple, Home Depot, which reported earnings earlier this week, P&G, United Healthcare, Verizon, J&J. We're seeing some upward momentum, and that's what's really boosting the indice here. We're also seeing Coca-Cola pop around 2% as well as McDonald's, as investors sort of see a reversal in where exactly they're looking in this market. As you can see here, technology leading the downward momentum in intraday trading today, whereas on the flip side, you do have materials leading the way here, as well as healthcare also leading the way here in intraday trading. So perhaps that risk-off environment here, not really investors trying to get risk on, but once again, taking a step back, all three major indices trying to hold on to some momentum this morning, with the Dow leading the way up about 0.6%. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching home builders, Elastic, and VinFast. First up, home builders. The stocks, including D.R. Horton, KB Home, and Pulte, they all are rising on increased bets for a December rate cut. New York Federal Reserve President John Williams indicated a near-term cut is possible amid a softening labor market. Investors had tempered expectations for further cuts amid a lack of data and persistent inflation. Next up is Elastic. It's a search and data analytics company, and it reported mixed quarterly results. While adjusted earnings and revenue topped estimates, investors are watching growth in its cloud business. Revenue growth in the division slowed to 22% from 24.5% in the first quarter. An analyst at Cantor Fitzgerald noted that Elastic's call implied growth in the cloud will decelerate further in the third quarter, those shares down 15%. And finally, VinFast, the Vietnamese automaker, reporting revenue for the third quarter that missed the average analyst estimate. It also reported a bigger third quarter net loss after spending heavily to expand its footprint and boost sales. Its loss of $910 million for the quarter was nearly double the year prior. The EV maker is facing intense competition in Southeast Asia, its largest market. However, its vehicle deliveries are up by 149% year on year. The shares down 12%. We've got more markets action coming up. We'll be right back. Personal finance expert Jean Chatzky stopped by Yahoo Finance Invest to talk about saving for retirement and how Americans can do a better job of it. She joined Bob Powell and Elizabeth Gore.
So, ladies, one of the questions that we got from listeners was around rolling their 401k into a checking account. Thoughts?
a checking account?
Well, yeah, that's the question.
All right.
Jean.
So
I think that's very dangerous.
Well, I think it's very dangerous, and I think when you roll it into something other than a qualified account, if you don't roll it into an IRA, you're going to face a lot of taxes.
And
potentially penalties depending on your age, right? So the rollover decision is a really, really important one. It is not a bad idea to roll over in any real situation, but you want to make sure that you're picking the place that you roll to carefully and that you don't take the money out of the tax deferred account, because then you lose all of this good work that you've probably been doing for decades.
And I think about human behavior. I think it's really important that folks are disciplined and their money is in environments that are not completely easy accessible. So that's what makes me nervous about that.
so we don't know the reason why they want to roll the money over. It could be emergency, in which case maybe you take a loan out, or maybe you can take an emergency distribution from your 401k. But if it's just to roll it over for the sake of getting access to your money, taxes and penalties.
Well, taxes and penalties, and you should be planning your withdrawals over that long period of your retirement so that you get the tax consequences right, so that you give the money more time to grow, right? It can grow tax deferred for decades longer. You just want to max that.
Yeah, so one thing that may save someone from making a bad decision is not all plans allow you to take distributions, right? So you have to check your summary plan, right, document, your SPD, to find out even if you can even do this before, like, take an in-plan distribution.
You got to do your homework and really research and not assume that one size fits all, right? Every product is different. When you put it in, your age, it all matters.
Yeah. So another type of retirement account that we get lots of questions about is the health savings account, right? Which everyone describes as the triple tax advantage account, right? It goes in tax-free, grows tax-free, comes out tax-free if you use it for qualified medical expenses. But some people want to know, can I overfund it? And if so, what's the penalty?
Well, first of all, I love HSAs, right?
Who doesn't love an HSA?
Right? I love them because they can become a supplemental retirement account, as you well know, right? If you can get yourself to the point where you are paying for your health care out of your current cash flow and you invest that money in an HSA and you let it ride, let it grow, then you've got this supplemental account. Once you get to retirement, you can save your health receipts for years and years and years and years and just write them off down the road. You can use that money to pay Medicare premiums. I mean, it's so valuable. Can you overfund it? Yeah, you could put more than the IRS allows you to put into it.
Right, but there are taxes and penalties on that, on the over the contribution at 6% per year. So you've got to either take it out or pay the penalty for as long as it's there.
Also, research and study what you can actually use it for. You'd be surprised in your life what you can actually use that fund for. That I think people just think I'm just paying a direct medical cost, but there are so many other areas that you can actually use that fund for. So again, go back and research, study, and understand the capabilities.
Yeah, so one question we always get, and I'm sure you get it too, Jean, is this notion of if I apply for Medicare, I have to stop contributing to my HSA typically about 6 months before you enroll, and otherwise you have to sort of take that money out.
Yeah, you have to time everything very carefully when it comes to Medicare, because there are a lot of things that can mess you up if you do it incorrectly. By the same token, it's not all that hard to put a little reminder in your calendar and just nudge yourself to stop paying that one bill.
Yeah. And I want to also shout out to the millions of people who are participating in elder care right now. They're doing this for their parents. And again, you have to do that research on behalf of your parents and understand for them. I care for 2 aging parents right now, and I'm in these decisions all day long. So you have to really understand what their products are before you help them make those decisions.
Yeah, so last question about HSAs. We know that when they were created, they were described as an IRA for healthcare expenses in retirement way back when. Most people, when they invest in HSA, they put it into a money market, and most of the time they're using it for current medical expenses. But for some folks who have the ability to delay using that HSA, you can invest it in the market. You can put it in a S&P S&P 500 index.
But you have to turn it on, and I've seen statistics about the fact that only 6% of people have actually turned on the investing function. I mean, there are some barriers to entry. Sometimes you need to have a minimum balance in order to invest your money. It's worth, as Elizabeth said, picking up the phone, doing a little research, and finding out if you are in the kind of HSA that gives you the option to invest, because not all of them do.
Do you have advice for small business owners who aren't working for a big corporation and they're thinking about these, how they find all that information?
There is a lot of information available at healthinsurance.gov. There's a lot of information available at AARP, actually has a really, really good vertical. I'm sure there's a ton on Yahoo. The point is to just go online and have a conversation with, whether you do it with ChatGPT or some other bot, about what is out there. And don't give me that face.
I'm going to say, if you're going to use AI, double check.
I think he just had a small heart attack.
I had a moment.
He just had his own reality check.
I'm like, AI.
No, but I mean, I do this pretty much every day. I go on, I have a conversation with AI about something I'm trying to learn, and I tell it that I want it to give me realistic, viable, credible sources that I can believe in, then I fact check it, as we all would.
And I think that's the medium, right? I mean, it's your starter kit for information.
Don't take it at face value.
But then you go exactly to the source, to the products and services you actually are using, and then fact check it.
Exactly.
All right, so in your experience, what small habits have the biggest risk of cascading into the biggest financial crises? And I'm thinking about credit card debt, or not having a budget, or not having health insurance. What are your thoughts?
Being unconscious is the overarching habit that gets people in trouble. Whether you're unconsciously spending because we just swipe and dip and click and tap and money moves so quickly, whether you are unconsciously not paying attention to your investments, you've got to get yourself to focus on what's coming in, what's going out, and where it's going. And if you know those three things, you're going to be in much better shape.
So many people just go, money, right? Like, it's too much work.
You know, it's gotten easier, I think, as a person who's not a deeply financed person. And I would say the biggest mistake for my audience, for small business owners, is not starting. So they tend to wait to pay themselves. They tend to wait to start their 401k. They tend to wait to start putting money into their medical expenses. So I think the biggest mistake they can make is, whether you're making $1 or you're making $500,000 a year, you need to start putting money away for your own services. Even if you're a solopreneur, it's really important.
I run into a lot of small business owners who believe that their business is their retirement plan, which is such wonderful optimism, but we know,
it's very little
it
times
doesn't,
the case.
It doesn't always turn out that way.
Markets have been unusually volatile recently, as unpredictable and erratic as the weather itself. And when the sky flips fast, you check the weather forecast. And in markets, that forecast is the VIX, which is exactly what we're breaking down on today's Stocks in Translation, along with options expiration, which is adding another dimension of odd wonkiness to market behavior. First, let's dig into the VIX, also called the CBOE Volatility Index. This is our main weather gauge for the market, and it's calculated on options that trade on the S&P 500 about 30 days out. Now, most retail investors operate on a much shorter time frame than that in the options market, so the VIX is more a measure of how much protection big money on Wall Street is buying. As Interactive broker Steve Sosnick likes to say, don't call the VIX a fear gauge. The VIX is not necessarily based on emotions. And when these big investors rush to buy protection, they're seeing some weather patterns that might not be visible on the horizon. And when they buy en masse, the VIX spikes, just like a storm warning might light up your weather app. There's also a seasonal weather pattern to the VIX. It tends to be higher on average in October and November, as that's when we've seen some big swings historically. Now let's take a look at how the storm warning has changed over time. And we got a chart here of the VIX going back to the beginning of the year. So this is year to date, and we're putting on a 50-day moving average as well. That is showing up in blue. This smooths the VIX's choppy and spiky price patterns. And you can see that big spike around Liberation Day in early April. earlier in the year, and recently we had a spike in mid-October. That was a China tariff scare. Now the current spike just got a little bit bigger than that, but not nearly the size of that April spike. So we're only expecting some squalls now, not a hurricane, though that can change quickly, just like the weather. Now look at that 50-day moving average and how it formed a sort of ceiling for the VIX after it calmed down in May. The VIX started using that average as a floor. That was a signal that the market patterns were changing, and we might expect more storms than usual, even on days and weeks when the sun pops out. So now let's talk options expiration, or OpEx, and we have a handy guide for that right here. These days, we have options expiring every day of the week. But on the third Friday of each month, and that's November, that's the 21st, we have the monthly options expiring. And this is the one that you can see bigger market-wide effects at times because there's a lot of money's worth of options expiring. Now, investors can buy options on indexes like the S&P 500 and individual stocks, plus ETFs and futures, but index options usually settle at the market open on Friday, while the others usually stop trading after the market close. Some of the heavy selling that we saw during the week was due to the buildup of index options around certain prices. But as these bets and hedges roll off on OpEx day and new contracts are written, this can be a sort of reset for the market. Sometimes we also get some quirky activity on options days, but usually the indexes have lower volatility than usual. This happens as big stocks get pinned at certain price levels because of their own options activity. Suffice to say, there's a ton of math involved and options are not for everyone, but it is helpful to know when there's a possibility of a squall forming out of the blue. So how do we use all of this heading into Thanksgiving week? First, we want to watch the market weather patterns and what they actually are. Do daily stock swings start to shrink, or do they stay big? What tells you whether the weather storms are moving out or still rolling through? Then you got to watch the weather forecast. Does the VIX itself ease back down? That suggests that demand for protection is fading. Or does the VIX stay high, which shows that higher demand for protection by Wall Street is there? And by pressing that a little bit further, we can also ask how the VIX is reacting around those recent highs and lows and how it behaves around that 50-day moving average. Is it spending more time above or below it? Because that can tell you when the forecast is changing. It takes a while for the VIX trend to change, probably a little bit longer than a holiday shortened trading week, but if you keep an eye out on the VIX regularly, you'll learn to start some early changes in its behavior. And the good news is, you can do all of this easily with the Yahoo Finance app or website. So tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
89% of American consumers plan to celebrate Thanksgiving this year, with the majority planning to serve a turkey as part of that celebration. That's according to Butterball's annual Thanksgiving outlook. But when shopping for that Thanksgiving meal, you could be faced with higher costs. The USDA estimates a roughly 40% increase in wholesale turkey prices from 2025 this quarter. Here with more on how Americans are navigating the current conditions is Jay Jandrain, Butterball's CEO. Thanks so much for being here.
Glad to be with you. Thanks.
So talk to me about what's going on with costs to raise turkeys for you guys. What are you seeing in terms of input costs? What effect did avian flu have? How are those dynamics working?
Well, fortunately this year for Butterball, at least, we've had pretty steady costs coming into this season. And avian flu hasn't impacted us directly, but we have seen it in the industry. So it certainly has some impact overall when we look at the turkey industry and what the offerings may be to the consumer. The good news is it hasn't been to the impact that it's going to cause any shortages or lack of supply for consumers at this holiday. And the other, another great point in looking at the graphic you had up there a moment ago with regard to wholesale prices, that doesn't necessarily relate to exactly what the consumer is going to see in the market. And good news for consumers, particularly with Butterball brand, we're actually seeing a number of very significant retailers with lower prices this year than they actually had on our turkeys last year. So it's really a great buying opportunity for the consumers for this holiday season.
Yeah, I have to admit I was pretty shocked when we were talking with the Walmart CFO the other day, and he said you could get a whole Thanksgiving dinner there for $40, which to me is like the bird alone can cost some people $40 depending on the size of it. So then do these retailers are seeing it as a loss leader, a way to get people in the stores by giving some discounts on the turkeys?
Well, they certainly look to do that. I mean, that's the hook to get people in the door, right, for the holiday. The other graphics you had up, but with 89% of the people that we surveyed celebrating the holiday, and 84% of those are going to have turkey on the table. That's what they're going to buy, right? So that's going to get them in the stores. That's going to help to round out the rest of the basket. So that's a very important sale for these retailers during the holiday. And we're glad to be a part of that and helping them partner with our retail partners to get those consumers to keep buying turkey and keep celebrating the holiday.
Jay, I'm curious that share of folks who plan to serve turkey, how much that's changed over the years? Because just anecdotally, I know some people who say, I'm not going to do a turkey, I'm going to do a chicken, I'm going to do something else entirely on the Thanksgiving table. Have you seen a waning at all in people serving turkey?
Well, we hear more about more alternatives, but consumers still go back and put turkey on the table. One thing that we have seen a little bit of a shift in is that while they might not be buying as many whole birds, they might be buying a bone-in breast or a boneless roast. And in some cases, they may buy a whole turkey, and then they may complement that with another product that we offer because they don't need 2 whole turkeys on their table. So we're seeing a little bit of a shift in how they're buying and what they're buying, but it remains really focused on turkey for this holiday.
And what about in terms of the size of the turkeys that you're offering? Does that sort of change year by year? Is the demand for sizes change year by year?
It's pretty steady. We did see a little bit of a change, though, during COVID. Obviously, we had fewer people gathering at that time. We're back to pre-COVID levels with 9 to 10 people participating in any given meal. So we did see a bit of a shift there as far as what the consumer was looking for. Obviously, if they're going to have less people at the table, they won't need quite as big a turkey. Or maybe they want a bigger turkey and they just want more leftovers after the holiday too. So, but we have seen a pretty standard spread in the sizes of the ranges that consumers are picking up back to pre-COVID levels.
And Jay, I am curious. We keep hearing about consumer spending and the K-shaped economy and lower income Americans in particular struggling. Have you seen any of that kind of effect in the business?
Not in ours, thankfully. We're seeing food inflation has been certainly something top of mind for consumers, not just for the holiday, but throughout the year. And we're seeing more of that. And particularly in other proteins, we've seen some acceleration in that. It's actually been a benefit for Butterball and for the turkey industry. We find some opportunities to sell some of our other products, for example, ground turkey, which may be a better value than ground beef at this time for some of our consumers. And we see some trading in that. When beef prices get extremely high, there is some relationship to people trading to turkey. And then certainly it's our job to make sure that when prices do mediate, that we continue to have them purchasing turkey and not going back to beef.
Lastly, Jay, when you're cooking up your Thanksgiving meal, are you going to be wearing the Butterball Thanksgiving hosting pants, which apparently were a new thing this year?
I absolutely will. It's actually, I've got them sitting here in my office with me right now. And we had our Friendsgiving here in our office a week or so ago, and me and all of my team had them on. So you bet I'll be wearing them.
They're already sold out, I hear, unfortunately, for the rest of us. Jay, thank you so much. Happy Thanksgiving.
Thank you. Happy Thanksgiving to you.
Thanks. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.